TGIF. I'm Yahoo Finance Executive Editor Brian Sozzi, and now I'm getting some friendly heat from you all on X, on an X video I posted today, pre-6 a.m. There is that video right there. It was actually live. I began rolling around 5:30 a.m. from inside Yahoo Finance HQ with a full stream of consciousness on the software stock crash. Some of you appear to not have liked that I called this a crash in software stocks. How else could you characterize it? I mean, give me a break. I'm not being alarmist here. Workday is down 30% in a month, despite zero indications the company will be going out of business next year because of an Anthropic model update. Send me a different word to use and I'll use it. And don't tell me it's simply a pullback. I do not want to hear it. I'll put you on block. Meanwhile, others were hoping I would hop to the mic and offer up a shopping list of software stocks to buy. I'm not going to do that because one, I no longer pick stocks as it's not my job anymore. And two, I don't believe the bottom in software stocks is in. Sorry to disappoint you. And this brings me to my guiding light for today, contagion. Remember that word from the great financial crisis? Well, I am dusting it off today. Why I'm worried about this new phase of the software stock crash is that it looks to be spreading to other areas of the market. We witnessed that during Thursday's brutal session for stocks. It was sell first, ask questions later, and Wall Street and markets are beginning to take notice. I suggest you take notice too. Two people I know have taken notice: Tim Urbanowicz, Innovator Capital Management Chief Investment Strategist, and Yahoo Finance Senior Reporter Inez Ferre. Tim, coming to you here, are you worried that this contagion, which I would argue began yesterday in markets, that this software contagion starts to spill over and this is just the early innings of this?
Well, Brian, I do still think there's a very supportive backdrop for stocks out there. As you know, we have the S&P 500 pegged at 7,600 by the end of the year. That has not changed. But one of the risks that we highlighted in our 2026 outlook was what we term the dark side of AI. Everybody wants to talk about just the benefits and how it's going to be a change for good, and that we absolutely buy into that. But you have to look at the other side, and we really see that dark side playing out in two ways. One, what is the impact going to look like on the labor market? How big of a spike in unemployment are we actually going to see with layoffs that are triggered by AI? Right now, those have been contained. The mass layoffs that we've seen recently, only about 15% of those have been related to AI. The other piece of this is what other industries are they going to disrupt margins and even the entire industry altogether. And I think that's what you're seeing in the software stock space right now when we have a category that just not too long ago, Brian, these stocks were trading at about a 35x multiple. Now they're down below 20. You're down 20% plus this year. That's a significant sell-off. That's the dark side of AI. And we need to pay attention to that because I do think there's going to be other industries that are disrupted, and this is certainly a threat. And even if it isn't a threat that plays out this year, it's something investors need to prepare for and watch out for volatility in their portfolios, because it's going to scare investors. It's going to scare investors, so we need to be prepared for that. It's not just going to be up and to the right like some people hope.
Tim, are we in a dark period yet for software stocks, despite them falling aggressively, or is that just I enter a room and the lights have been dimmed a little bit and we're about ready to get full on dark?
I would agree with you, Brian. I don't necessarily think the bottom is in here. I do think we could fall further. And that's just, you look at where the margins are. I mean, margins are through the roof in this category of stocks. Those haven't come down yet. And valuations still are, pretty elevated. So they've come down. I think it's a better entry point, but I would be in your camp that I wouldn't call a bottom in this category quite yet.
Inez, weigh in.
Yeah, look, like what Tim is saying, we may not see a bottom because the investors are taking note of what's happening with the cost of coding, which is going down, with the disruption concerns. And it's not just in software, it's now in transportation and logistics, it's in wealth management. I mean, what area is not going to be disrupted by AI? And so I think that this is what the market is starting to sniff out. Oh, you mean that there's now going to be a disruption in these business models because you can have a startup that comes up and says, look, well, I can do this for you at a tenth of the cost of what you are getting from one of these bigger companies. So this is sort of disruption in real time that you're seeing, and with this what we saw yesterday with the pullback, although you don't want to call it a pullback. But
Inez, don't tell me. Inez, I'm cutting you off right there. Don't even tell me. Don't tell me there's a pullback. Come on.
The crash.
There we go, Inez. Thank you.
Look, as you saw tech that was going down yesterday, and these in logistics and transportation companies that were down double digits, et cetera, you were looking at Walmart that just closed at an all-time high yesterday. So certainly investors are going fully defensive here as they see what's happening. And by the way, there was this tweet that was going out, this Substack this week also that was talking about the impact of AI. All of this is feeding into what is this going to do to these traditional companies, these big, these tech companies that have high margins. What is this going to do to their business models?
Tim, how do you hedge against this?
Well, Brian, as you know, I spend most of my time working with elite financial advisors across the country. And right now, this year in particular, we're seeing a lot of these advisors turn to a new category of ETFs, dual directional strategies, and I think as a way to really hedge out a lot of this risk. The unique thing about this category, which is raised about $1 billion over the last 6+ months here, is it gives the advisor the ability to make money when the market goes up and when it goes down. So one example here, DDFF, the February 15% dual direction. Over the next 12 months, you have the ability to capitalize on the first 9+% of the move up in the S&P 500. And then on the downside, you also have what's called an inverse cap of 15%, meaning that if the market goes down 0 to -15, you have the ability to make 0 to +15. So you have that inverse cap. So a lot of these elite advisors are using these strategies as a way to really cover a wide range of outcomes. And they're taking a step back and looking at this. We've just come off 3+ years of 20% annualized gains. Do we really think that the market's going to go up more or much more than 9%? The likelihood of that is low. So being able to produce that positive total return when the market is going down, really, really important. And that's where we're seeing a lot of money flow in the ETF space.
Inez, what I didn't like, that's some good stuff, Tim. Thanks for bringing that up, man. What I didn't like about yesterday's session, Inez, is that even gold sold off. Where's the safe haven trade here?
Yeah, gold sold off and silver sold off even more, although now you are seeing gold that's going up a bit. But look, it was fully risk off yesterday. I mean, you had everything that was selling off. You had stocks that were selling off, you had gold, you had Bitcoin, you had all across the board, even energy that was selling off. And these are some of the areas that have done so well, right? You've got XLE that's up year to date. It's one of the best performers, staples, all these other sectors as well that as they have outperformed tech. But certainly yesterday was a big drawdown. I wouldn't say that it's though long-term because you still have Wall Street that's really bullish on gold at least.
What I find so interesting, Tim, is that in this environment, really everything seems to be sold. Apple has gotten smashed this week. Why is it the sell-offs in software being viewed as good for the Mag 7? The company's plowing billions of dollars into CapEx. I look some of the forward price to earnings multiples on some of these Mag 7 names. I can't recall when they have been this cheap.
Well, Brian, they're cheap, but if you look at what's happening outside, in the economy as a whole, we think this rotation trade is really just getting started, where you're going to continue to see capital allocated down the line here. You look at small caps, you look at the S&P 500 equal weight, emerging markets, EFA, all handily outperforming the S&P 500 and the NASDAQ thus far this year. And I think, we've talked about this a lot, but the K-shaped economy that we've seen where the AI cycle really disrupted the typical economic and market cycle, we think that's coming to a close. We're heading into an environment where you have 175 basis points of Fed cuts that are starting to make their way into the system. You have fiscal policy that is supportive. You have tax cuts coming to the average American. They're going to be about 30% higher than they were last year. We have PMIs above 50. So the growth backdrop is very strong. And when you have a growth backdrop like that is strong, you have to look for pockets of the market where expectations are not as high. And we see that outside of the mega cap, big tech names where the expectations are still pretty high. There's still a lot of excitement around AI. And also, Brian, where you start to see those CapEx spending concerns coming in, which is another source of volatility that we think is going to be playing out all year. So there is still a lot to like about this market. We think the economic backdrop as well and really continues to support that broadening out trade. We think it's just getting started.
Inez, fire up your K-shaped economy chart.
Yeah, look, B of A came out with credit card spending and debit card spending, and it went up in January, the largest increase since February of last year. But what they're saying is that they are seeing this K-shape that is changing slightly, whereas before you had the middle and higher income that were spending, they are starting to see some softening in the middle income. So they're saying that the tax rebates could be, the tax refunds could be good for a little bit, but you have to keep an eye out, because after tax season, if this middle income continues to soften, this could be troubling for the economy, because it's that middle and higher that have been keeping things afloat.
Let's end it here, guys. My word of the week here, just thinking of all the action, the sell-offs we've seen in Bitcoin software, my word of the week here, friends, is contagion. Tim, what's yours?
I would say consistency. You need to watch out for that. We think that a lot of the volatility that you're seeing with AI disruption, and also just concerns about the amount of CapEx in the hyperscalers, that's something that is going to be triggering investors' nerves really the better part of this year. So you got to prepare for it. Consistency.
Inez, final word to you.
Disruption.
Ooh, I like
100%.
that. Disruption. You know, I'm the host of this freaking show. I gotta have the best word, but I think you got the best word, Inez. I mean, come
Yours
on.
is pretty good too. Yours is pretty good.
Look, you guys are the best. All right, have a great weekend, y'all. Watch out for that volatility next week. It ain't going anywhere. All right, I'm going to calm down software stocks for a little and fire up another topic I'm vibing about right now, and that is crypto. A key member of the Trump administration's crypto team joins me next.
The Bitcoiners are much more used to volatility than the traditional public market investors, and I think that's why you see people kind of just saying, look, we know where we are, we understand what's happening. Actually, if I liked it at $126,000, I'm more likely to buy it at $68,000.
On the regulatory side, I think all we're looking for is clarity. The Clarity Act would be great. Anything else from the regulators, we just want to be able to build in a regulated environment for our customers.
Bitcoin remains the best performing asset class of the past decade. We've been through cycles like this many times at Coinbase, and adoption continues to grow. Regulatory clarity is on the horizon, and I'm more bullish than ever.
And those are the vibes at the moment in the crypto community, as Bitcoin has been close to cut in half from the October 2025 highs. Some sources I talked to remain steadfast in their belief in Bitcoin, especially if the Clarity Act gets passed. Others think the Clarity Act getting passed is priced in, and the industry simply lacks a fresh catalyst. I want to put this to Patrick Witt. Patrick is the executive director of the President's Council of Advisors for Digital Assets. Patrick, welcome on Yahoo Finance. Good to see you here this morning. Let's start on that Clarity Act, because we heard a lot about it last night from Coinbase CEO Brian Armstrong on his earnings call. What is the status of this?
So the status right now, the House passed the Clarity Act, their version of it last year, over to the House in July, I believe. And the Senate has taken it up and made its own changes to it and is fashioning their own version. We were able to pass half of the bill out of the Ag Committee that handles the CFTC portions. And now we're just stuck in the Banking Committee for the SEC portions, the securities portions of that bill. So there was a markup that was scheduled on, I believe, January 18th that unfortunately got pulled down, postponed. But we're working hard to address the issues that were raised that led to the postponement of that markup and hopefully get that back on the books soon. And then once we pass that out of the Banking Committee, the two pieces of the legislation will need to be reconciled before a final vote on the floor. So more work to be done, but we're a step closer with the passage of the ag portion of this a couple weeks ago.
Patrick, who has to bend a little bit ultimately to get this over the finish line? Is it the crypto community or the banking community?
Not to be cliche, it's a little bit of both, and we've encouraged both parties. We've had conversations individually. We've hosted a number of meetings here at the White House. We might host another one again next week on this issue of stablecoin rewards and yield. And it's unfortunate that this has become such a big issue, because ultimately this is not the stablecoin bill. That was the Genius Act. But we've heard from senators on both sides of the aisle concerns about potential deposit flight from stablecoins on different platforms. And so what we've encouraged both sides to do is let's find a middle ground. Let's use a scalpel heel here to address this narrow issue of idle yield, let's call it. But let's not take a chainsaw to this. Let's not let this derail the bill. There is so much goodness in this bill, no matter what your perspective is. The banks, there's a lot of permissible activities. It allows these institutions to now play in the crypto space in a way that without that regulatory clarity, they wouldn't be able to. And then obviously from the crypto side, the regulatory jurisdiction, the clear lines between the SEC, the CFTC, developer protections in the bill. There's just a litany of excellent measures measures in here that are critical to future-proof this industry from a future Gary Gensler or, God forbid, Secretary of the Treasury Elizabeth Warren. So we want to make sure that people are approaching this the right way, that they recognize the value of this bill, and we're going to keep working to make it better, but ultimately it is a good product at the end of the day.
In the spirit of compromise, Patrick, do you think the crypto industry just has to get off this view that it's going to be able to pay rewards on stable coins? Does that get it through?
Again, as I said, there's a way to address this that doesn't disrupt a lot of the business models in the space and also addresses the bank concerns. So this is a major item. It's not the only one. There's still some issues on Title I with tokenization, the token taxonomy, and the authorities between the SEC and the CFTC, making sure that the SEC isn't swallowing too much of the CFTC's jurisdiction. And then on Title III with DeFi, illicit finance. So there are other issues that we need to work through, but this is a main sticking item, and we're not going to be able to get this out of the banking committee unless we address this issue. So that's why we've taken it so seriously, why we've hosted the different interested stakeholders here at the White House, and we're going to continue to stay at the table and encourage them to find a compromise on this issue because it really is the major gating item.
We'd love to get your take on this one. You know, when I talk to banking executives on this particular issue, they say that community banks just might struggle to lend to businesses if these crypto players are allowed to pay these rewards. I mean, do you share those concerns?
There's been a number of studies that have pointed in either direction. I think ultimately our bottom line is consumers win when there's choice. But we've heard from a number of senators, and again, it's bipartisan on this issue, that they want to make sure that the concerns of the community banks are addressed, that we're not doing anything that would cause deposit flight from their platforms. They are important pillars of the various communities around the country. And so I think we can do that. I think we're fashioning a compromise. Last week's meeting between the banks and the crypto companies, I think broke some new ground, established some new common ground, some areas of agreement, and we'll build upon that. But whether or not we agree with that view, I think I've seen studies that point in either direction. Ultimately, there's going to be a convergence between crypto and the banks. Right now, it is a new product. It's somewhat threatening to the community banks and not just the community banks, but also the GSIBs, the larger banks. But they're ultimately going to start getting into the crypto space. They can also offer stablecoin products to their customers, just the same as crypto. This is not an unfair advantage in either way. And then many of the banks are now applying for OCC bank charters themselves to start offering bank-like products to their customers. So in the future, I don't think this is going to be an issue, but we're managing through an interim period where there's a lot of people on the bank side of the table that feel threatened by this, but ultimately I think they're going to find opportunities to use these products and leverage them and offer new products to their customers and expand their businesses.
Should a Jamie Dimon at JP Morgan be threatened?
I don't think so. I think there's tremendous opportunity for the JP Morgans of the world to engage in crypto activities. If you just go to LinkedIn, there's plenty of job postings at JP Morgan hiring people into the digital asset space. So I think they're indicating that they intend to get into this space in a big way. They were present at last week's meeting, very constructive, and I think. Yeah, on the stablecoin part of this, there's the consumer banking side, but then there's also the institutional bank side. And as more and more liquidity gets added to treasury markets, with stablecoin being backed by T-bills, there's a lot of activity and commercial activity that the larger banks that have rates trading operations can get into. So I think for those larger banks that have those kinds of business lines and large practices there, they recognize what an opportunity this is.
Brian Armstrong over Coinbase. He sounded a little more optimistic, Patrick, last night on his earnings call about clarity getting passed, at least compared to what we heard from him at Davos in January. Do you think this ultimately gets passed in the first quarter, or is this more mid-year?
We're definitely on the clock. There's a window here. The window is still open, but it is rapidly closing. And so that's why we are taking it so seriously, why we're encouraging folks to cut the deals that they can, to stay at the table. Let's not let any moss grow here. We got to get this done because, as I mentioned, it's one step in the process. If we can get this out of the banking committee, it still needs to be reconciled with the ag portion, and ultimately there's going to be a cloture vote and a passage on the floor. That all takes time. And the most precious real estate in Washington, D.C. is Senate floor time. So we're in regular touch with Leader Thune about that, but he knows that this is a priority for the president, priority for my boss, David Sachs. And I do believe we're going to get this done. I won't necessarily put a date on it, but before the midterms really start to take all the oxygen out of the room, we have people engaged at the table that have invested countless hours on this bill, and we're going to get it done.
Lastly, Patrick, you're in the trenches on the Bitcoin reserve that is being built out here in the country. Where does that stand?
So with the passage of the executive order, what we wanted to do with that is get an accounting of what the government held and then also stop the bleeding. So stop these agencies from willy-nilly liquidating digital assets that they had, sometimes at fire sale prices. I think by some estimates, based on the sales and the way that they were conducted under the previous administration, we the government may have lost out on tens of billions of dollars that could have been held on our balance sheet. So right now we've stopped the bleeding. We're in regular touch with the agencies, monitoring the current status of the digital assets that they hold, making sure that the accounting is complete, not just Bitcoin, but obviously many of the wallets hold different digital assets in there that need to be appropriately accounted for. And then on the Hill, there's the Bitcoin Act that Senator Lummis had introduced. There's going to be a new bill introduced by Representative Begich in the House that builds upon that and allows some of the necessary authorities to centralize, properly safeguard these assets, and then explore budget-neutral ways to add to that stockpile. And then in the future, ultimately, if Congress decides to move in that direction, to allow for us to potentially add to that with outright purchases. But that would need to be an appropriations decision.
Patrick, good to see you. This is the context we needed. A very important moment here for the cryptocurrency industry. We'll talk to you soon.
All right. Thank you so much.
Appreciate it. And I'm dropping the mic on software stocks to end my week. Here's what Superhuman CEO Shishir Mehrotra told me about what your job may look like very soon.
I don't view it as a job taker. I view it as a job expander. So in my mind, we're about to give everybody 100 new employees. And I think what's about to happen is we're going to teach everybody management skills.
If that doesn't say it all about the stock crash, then I better just retire. Have a great weekend.